Hi, accounting class. It's another great day to do accounting. Today we're going to be looking at chapter 10. This is going to cover time value of money and long-term liabilities. So time value of money, long-term liabilities. So under this storyline, this company needs a lot of money to expand. So we're going to see examples of how companies raise a lot of capital, not just a few months of capital, but large sums of money to fund expansion or other projects. So when a corporation needs large amounts of capital, it has a few options. We can issue long-term debt. Long-term debt, the most common type we're going to spend a lot of time on is bonds payable. We'll also see later a notes payable, long-term portion of it. Or they can issue equity. And the most common type of equity that's issued is something called common stock. Third option I just put in there, we can have an extremely wealthy relative to loan us money to invest in the business. But for the most part, we're just going to focus on these top two, long-term debt or equity. So it says if we issue bonds, we're legally obligated to make periodic. So a bond has periodic interest payments. And for us, that's going to mean 6 months. We're going to see this word semi-annually in all the bond problems. So interest is going to be paid every 6 months of interest payments. And we had to repay the principal or face value of the bond at the end of its life. So bonds can range for anywhere. I mean, they can even be beyond 30 years, but generally 5 years to 30 years is kind of where most of them are going to fall. So they're long term. Notice long term, we're going to see the definition means more than 1 year. So it definitely has to be more than 1 year or it's a current liability. Yeah, so here's the disadvantage with bonds. If we finance with bonds, we have to make these payments. We're legally obligated to make these payments, and if we don't, we can be forced into bankruptcy. The good news, though, is that the owner of the business retains control of the business. We're going to see if they issue equity, if they issue too much equity especially, they can lose basically the ownership of the business, deciding the direction of the business and important business decisions. Bonds also always create something called financial leverage. We're going to see financial leverage and how it impacts the earnings per share. But basically, leverage of any type will make good years look even better and make bad years look worse. In finance, it's called adding risk. In finance, the word risk doesn't mean like we think of risk as something bad happening, but risk in finance equally means something good happen. It's just a wider array of options that can occur. It's not necessarily negative in nature. So, on the other hand, if we do equity, we have no obligation to ever pay a dividend. No obligation to ever pay a dividend, but the owner gives up ownership of the business because that's what they're selling. If they're selling equity, they're selling the ownership of the business. And if they sell over 50% of the ownership, then the owners could basically vote for their board of directors for the business and fire whoever was the previous owner. So it's happened to some famous people. I guarantee a guy from Men's Warehouse, and Steve Jobs at Apple. He eventually went back to Apple and he made all the other stuff, but there was a time period, if you look up his history, where they let go of him. So which to choose? Most corporations use a mixture of the two, and it's a significant topic in corporate finance, what the optimal balance between these two, equity and bonds, are. So most corporations do have some mixture of both. All right, we're going to get into time value of money. So these are important to understanding long-term liabilities and long-term assets. But we're only going to cover the long-term liabilities in this course. Long-term assets, the capital investment analysis is in Accounting 2302. All right, what does time value of money say? It says that money today is worth more than money in the future. Why is this the case? Because we can invest money that we have today and use it to generate a return. You can say this the opposite way. Money in the future is worth less than money today. So if we're going to receive money in a few years, it's not the same as receiving it today. We can't invest it in projects and earn a return. So we're going to see in a bit, we're going to try to take money that's in the future and get to its present value equivalency, but we have to discount the money or discount the future cash flows to get them to their present value equivalent. How much less is it going to be? That depends on two factors, the amount of time and the interest rate. So an interest rate is effectively just the cost of money. If you're in economics, you learn a lot more about these things, but the Federal Reserve is going to set these short-term interest rates. Longer-term interest rates are still set by buyers and sellers of securities effectively. Alright, so here's the math formula that allows us to convert the future cash flows to its present value equivalent. So we're going to take cash flows that are in the future, maybe a year, 2 years, 5 years, 10 years in the future, and get to convert them to today's dollars. And we can do that with this math formula. I know a lot of you are like, ew, that looks ugly, I don't want to touch it. Don't worry, we're going to do this with tables anyways. So we're not going to really necessarily need that. I'm just showing you the support of how I calculate this stuff. So I use this formula in Excel, and I can make a table that we're going to see on the next page. So the title of it is present value of $1. I chosen $1 because then we can take any figure here and multiply it by the dollars in the problem and convert it. So along the horizontal we have 3%, 4%, so on. So we have the discount rate or the interest rate that it's being borrowed at. So we have the interest rates here, and then we have the number of periods here, not necessarily years. Again, we're going to be thinking a lot with bonds that are semi-annual, have 2 periods in a year. So these are periods, not necessarily years. And the interest rates aren't necessarily for a year, they're the interest rate per period. Alright, so let's get some practice doing this. So find the present value of $10,000 to be received in 5 years at 6% interest. Oh yeah, one other point I was going to make about this table. All the numbers on it are less than 1. That's because we're discounting. We're taking future cash flows and bringing them back in time. So they're going to be worth less because of the time value of money. How much less depends on the interest rate and the number of periods. These tables, yeah, they're always used in academic settings, but you never use them in professional settings. We have calculators that gain more precision. Imagine if we have a really large number, you know, we're losing some efficiency because we don't have enough decimal places here. Let's get back to the question. $10,000 to be received in 5 years, 6%. So we just need to find the 5-year 6% number on here. 5 periods, 6% per period. We're going to take the cash flow and multiply it by this number, the 0.74762. So we see the amount of the cash flow that we're bringing back times the rate that we looked at in a table. And we get to the present value equivalent. So if we're going to receive this money in 5 years at 6%, it's not worth $10,000 to us now. It's only worth $7,472.60. Alright, the same thing, present value of $10,000 to be received in 10 years at 6%. So this time it's still 6% interest, but it's 10 years. 10 years, 6% is right here. So the 0.55839 is what we're going to multiply it by. And if we do that, we get to a number of 5,500-ish number. Alright, so let's compare what happened here. What really changed? It went from 5 years to 10 years. That's the only change here. And what happened to the figure? It went down even more. So the further in future the cash flow is, the more it's discounted under time value of money concepts. We're going to do a couple more because I want to show you what happens with if the interest rates change. So this time it's $10,000 to be received in 8 years, 4%. So 8 years, 4% is this number, 0.73069. And then we're going to look at $10,000 to be received in 8 years again, but this time at a 10% interest rate. So 8 years, 10%, 8 years, 10%. Hopefully my eyes aren't off. It looks like the 0.46651. Okay, now it's at the right number. So 46651 is what the table returned, and if we multiply it by the 10,000 we get to 4,000. So notice what happened, the interest rate increased from 4% to 10%, and the cash value got discounted by more when we did that. The conclusion here, and this is consistent throughout time value of money, the higher the interest rate, the more a future cash flow is discounted. The next type of problem, this is going to be something called an annuity. So this is $10,000 to be received not just once, but each year at 5% interest rate for 5 years. So what we're going to do, we're going to see 5 different calculations here added together. 10,000, let's look at the 5% for 5 years. So we're going to multiply 10,000 times this number plus 10,000 times this number, one more down, times 10,000 plus this number, times 10,000 plus this number, times 10,000 plus this number. And this is longer because it is all that. All right, so we did that for 5 of them. I know that's a lot of work, and I'm getting to a point here. We're gonna see in a second. Let's look at the next question. Find the present value of 10,000 to be received each year at 5% for 20 years. That one took 5. This is gonna take a lot more room than what I have. So what I answered it is I don't want to use this table to answer that. I don't want to do this 20 different times. So we're going to move on to the next point, which is the present value of an annuity. So first, define what an annuity is. An annuity is a series of equal payments, so it's more than one. The payments have to be equal. A good example, if you own a car and have a car payment, it's an annuity, or most likely an annuity, and they're for equal periods of times, i.e. once every month, once every 6 months. To do this, we're going to have a new math formula. This incorporates an annuity, but you don't really need to remember it because we can break it down in tables, and if you're ever answering questions like this, you'll be provided with the tables. Notice here, this is for an annuity. So we got 2 different tables. Don't confuse them. This is the present value of just a single payment, one single payment. This is multiple payments. There's 1 payment per period. So this is an annuity. We have to line up, if it's monthly, then we'd have to line up the number of periods being 12 in a year. So this is the number of payments have to correspond to the number of periods. So this is an annuity. That's why we can get numbers here that are larger than 1. The first row isn't going to be larger than 1 because it's a single payment, which technically isn't an annuity, but it's still listed here to be complete. But every other number is larger than 1, not because we're still discounting it, so we're still discounting the future cash flows. It's just there's more than 1 of them. So then notice this number is a little bit less than 2 because it's being discounted a little bit, but the numbers can be greater than 1. Alright, so find the present value of $10,000 to be received each year. That's what makes it an annuity, at 5% interest for 5 years. So all we need to do is look at the 5 years, 5%. 5 years, 5%. This is the number, 4.32948. And does that number look familiar? Let's go see. 43, it should be that number, isn't it? 43, yes. So we can do the math. That's the point with the annuity table. Why we have another table is to answer questions like these bottom 2, which are annuities. It very much simplifies the question. Instead of this big long formula, we only need to do this. And also this table allows us to answer the second question, the $10,000 to be received each year at 5% interest for 20 years. So we're going to look up in our table the 5% and the 20 years. So 20 years is all the way down at the bottom. I got to figure out 5% is the third one over. So it's going to be this 12.46221. So technically we don't need this second table. It's just we kind of want it because we don't want to be doing 20 different calculations to figure out the present value of an annuity. Alright, so a bond, this relating it back to bonds, bonds have 2 different cash flows associated with them. They have periodic interest payments. For us, that's going to be once every 6 months. We're going to see this word semi-annually in all the bond problems. So every 6 months they're going to pay interest. Bonds can pay interest yearly, monthly, different things, but semi-annually is the most common type, so that's what we're sticking with. So if we're doing the periodic interest payments, we got to use the annuity table, the second one, the one with numbers greater than 1 on it. But the face value, the single repayment of face value at the end of the life of the bond, we're just going to use the present value of $1, the first table. Alright, on the next page we're going to look at some basic bond features. So a bond pays interest. It pays interest based on the coupon rate. This coupon rate exists inside the bond document, the bond indenture. This is the legal contract between the two parties. So the coupon rate determines the periodic cash interest payment. So whenever we need to figure out how much a bond is paying every 6 months, we're going to use the coupon rate. It's set in the bond indenture. This is the legally binding contract between the bond issuer and the bondholders. So this is where all the terms are set out for the bond, is in the bond indenture. Also, if they're callable or they have other options such as callable or convertible options, it will be described in the indenture. We're going to see examples of these two types later. Alright, but investors, the bond pays a rate, but investors don't have to buy this bond. They have a lot of options. So what investors can get elsewhere is going to be considered the market rate. For these similar, you got to compare up the same type of securities, the same type of risk, and the same time period of the securities. But what they can get elsewhere is the market rate. What the bond is paying is the coupon rate. So we can have a comparison of these three, and these three are the three different scenarios we're going to see when we record bonds. If the coupon rate of the bond is less than the market rate, is the first scenario. In this scenario, the bond is paying a lower interest rate than the market, so the bonds look less attractive, right? Because the coupon rate is lower than the market rate, the bonds look less attractive to investors, and the bonds will sell at something called a discount. This means that they're going to sell at below their face value. In the second scenario, the coupon rate is greater than the market value. In this scenario, the bond is paying a higher interest in the market, so the bonds look more attractive to investors, and they are willing to pay more than face value for the bonds. As such, is said to be sold at a premium. The third option, if they're equal, the coupon rate is equal to the market rate, then there is no premium or discount. And we're going to like the third one the best because it's the simplest one to record. We're going to see these premiums and discounts give us problems to record. Alright, so we can use the tables and the time value of money to actually calculate the present value of a bond. What investors are going to be willing to pay once we know the coupon rate and the market rate of interest. Alright, calculate the present value of $100,000 5-year bonds with 6% interest rate. That's the coupon rate attached to the bonds. Interest payable semi-annually. That means we're going to split up a year into two parts. So we're going to think of the periods as 6-month periods. So there's actually going to be 10 6-month periods in 5 years. And the market rate of interest is also important. It's 8%. Alright, so there's a lot of variables going on here. First of all, the word semi-annually just means that we're going to cut the yearly interest rate in half. So semi-annually, just think it means every 6 months. So in order to use the tables, we have to convert the interest rate to the interest rate per period, right? We can't use the 6 and the 8. We have to get the interest rate per period. We basically just divide them by 2. The first part, the cash interest payment. The cash interest payment will always be equal to the face value of the bond times the coupon rate, and in our case, since it's semi-annually, we're going to divide by 2. So that's what we're going to see here. The $100,000 face value times the 6% coupon rate divided by 2 because it's semi-annually equals $3,000. So there'll be a $3,000 cash interest payment every 6 months for 5 years. The market interest rate. Market interest rate is given at 8%. We're just converting it to its per period interest rate. So per period per 6 months, it's 8 divided by 2. It would be 4% for each 6-month period. So this is going to be our discount rate. That means this is the rate that we're going to look up in the table. We're not going to be using the 6% or the 3% for the coupon rate. We're going to value it based on this rate, the market rate of interest rates, because investors are looking at it from their point of view, what they can get elsewhere, and they can get 4% elsewhere. So this is the discount rate. Discount rate means it's the one that we're going to look up in the table to value both the cash payments. So notice both of these are 4%, not the 3%. Alright, number of periods is simple, 5 years. every 6 months is a period, so 2 per year. 5 times 2 equals 10. 10 periods. Alright, so we need to calculate the present value of $3,000 to be received each period for 10 periods at 4%. So we need the annuity table, right? Because it's each period, we need to look up the value for 10 periods at 4%. 10 periods at 4%. We're on the annuity table. 10 periods at 4%. Here's 10 periods. 4% is right here, 8.11090. This is the present value factor to convert it. So we have the 3,000 and we see that figure we just looked up, 8.11090. If we multiply it, I've rounded to the nearest dollar here. So if you multiply it, you probably get a decimal. I'm rounding it to the nearest dollar. In addition to that, we need to, the bond's going to repay its face value at the end of its life. So we need to value what that's worth. The $10,000 to be received once, but at the end of 10 years at 4%. So we need to go back to our first table, plug in 10 and 4%. So we go all the way back to the first table. Alright, 10 periods, 4% equals 0.67556. Do the math. Alright, that's the present value of the face value being returned. Notice it got discounted quite a bit because it's dragging back 10 different periods and at a 4% interest rate. Now the total value of the bond is going to equal the net present value of all its cash flows. So we're going to add these two together and that'll give us the value of the bonds. Alright, so if we issue these bonds, people aren't going to pay us $100,000 because that's its face value. They're only going to pay us $91,889 because that's the present value of all the future cash flows. And this is going to present us with an accounting problem. We're going to owe them the face value. We're going to put this on our books as a liability because we owe them $100,000, but we're only receiving this much in cash. That's why the difference is going to have to be recorded as a discount. Alright, so journalize the issuance of 100,000. This is the same bond. So this is the same bond we were just talking about. Notice the number carries forward, 91,889. So we're going to receive cash. We'll go and do this. Date is just 1/1. We're trying to simplify the dates. This one. And cash of 91,889. Now, we have the liability, the bonds payable. We got to put it on our books at face value. So bonds, it's general rule here, bonds will always go on the books at face value. They will always come off at face value. Always 100% of the time. Alright, so there is a difference here. We're going to calculate the difference. I get this 8111 number by taking 100,000 minus 91,889. The debits and the credits have to balance out. And since we got less money than the face value, this is called a discount. So the new account here is called discount on bonds payable. So this discount on bonds payable has a normal debit balance, and it's a new type of account called a contra liability account. Alright, so let's try and get a handle on what this is. First of all, if we owe someone 100,000 and we only got 91,889 in cash, it kind of sounds like we lost money, right? The difference there, 8111, why not just call it a loss? So that seems reasonable, but the reason we don't do it that way is that the bonds, the money, the 91,889 we'll get to use for 5 years. So the bond will benefit us for 5 years, so we're going to spread that loss out over the years of benefits. So that's why it's not going to a loss or an expense account here for the 8111. It's going to benefit us over that time period, so we're going to spread it out over those 5 years of benefit. But we do have to do something with this discount. Over the entire life of the bond, we have to write this discount off, or this thing that we almost want to call a loss. We have to write it off over time. So we're going to amortize the discount. Basically, it works just like depreciation. We're going to see the method here is called straight line amortization. It works just like straight line depreciation. Alright, so straight line amortization is not the GAAP approach. So what we're learning here is not the GAAP approach. I'm going to put in the appendix to this chapter the the GAAP approved method, which is the effective interest method. But for this one, we're keeping it simple and using straight line amortization. GAAP allows us to use it if it's not, they don't produce material differences. But under straight line amortization, it's simple. We're going to take the total amount of the discount divided by the total periods in this bond's life. It's a 5-year bond, but it's paying semi-annually, so there's going to be 10 different periods, 10 different interest payments. So we're going to take the total divided by the total number of interest payments. So 8111 divided by 10. Alright, so now we're going to jump forward 6 months into the future. We're no longer on January 1st, we're 6 months into the future. And we're going to journalize the first interest payment that needs to be made. So we issued these bonds, so we're going to have to pay cash. We're paying the first interest payment. Alright, the payment for the cash is always going to be equal to the face value, which is 100,000, times the coupon rate. The coupon rate is the 6%, divided by 2. We get to 3,000. In addition, we need to amortize that discount. Notice the discount has a normal debit balance, so to amortize it or write it off, we need to do the opposite. So we're going to credit the discount. Credit the discount on bonds payable. Notice here, discount has a normal debit balance, so when we amortize it, we're going to credit the account. Alright, the last one is just a summation of these two. And the account that it goes to is called interest expense. This is an expense. This is the cost of borrowing the money. So interest expense in this case will be the sum of the two. So notice that amortizing a bond discount increases the interest expense. And this entry is going to be made every 6 months. I'm only showing one of it because every 6 months it's the same entry. It just hits our books every 6 months related to this bond. What we're going to do is skip further into the future. We're going to skip 5 years later. So journalize the payment of the bond at the end of 5 years. Assume that the last interest payment has already been made. So at the last date, they owe one more of these payments. And they hold the $100,000 back. We're only going to record the $100,000. So what I'm doing here, it's January 1st, and it's 5 years into the future. Alright, so let's think about this. We're paying out cash. We're paying out the face value of the bonds in cash of $100,000. And we get to take the liability off our books. We're paying it because we owe it, so we're going to take the liability off, which is bonds payable, for $100,000. Alright, so that was one example with a discount. So this is the whole page is focused on issuing them at a discount, what we do with the discount, how we amortize it. Now we're going to look at the same scenario but at a premium. So we got to flip around. I think we flipped around the market rate and the interest rate here. So this time $100,000 5-year bonds, 8% coupon rate, payable semi-annually. And the market rate of interest is 6%. The cash interest payment will equal the face value times the coupon rate divided by 2 because it's semi-annually. So the cash interest payment will be $4,000 every 6 months for 5 years. The market interest rate per period here is going to be equal to 6% divided by 2. And then the number of periods, 5 years times 2 is 10. So the number of periods will be 10. So calculate the present value of the bond. I think we went through enough how to do this. I'm going to show you the solution. We'd plug in both the periodic 6 months. We'd plug this into an annuity table using the market interest rate and the 10 years. And then we'd plug in the $100,000 into the present value of $1 annuity using the same, the 3% market rate and the 10 periods. If we do that, so here's the annuity one, and here's the present value of a single dollar to bring back the 100,000. We get to 108,530. I've rounded this to the nearest dollars. So now we're issuing bonds. So we're going to recognize the bonds payable on our books for the full face value. Again, they always go on at face value, and when they come off at face value. This time though, we got cash in excess of that, so we got cash equal to $108,530. So the difference now needs to go on the credit side, and since it's on the credit side, or because we got more cash in the face value, we're going to put it to an account called Premium on Bonds Payable. Alright, the premium on bonds payable has a normal credit balance. It's considered a liability. It's not a contra liability. It has the same balance as other liabilities. So again, the same type of thinking here. Alright, so we're not going to call it a gain, that $8,530, because we're going to have the money. It's going to benefit us over 5 years, so we're going to spread it out over 5 years. I'm getting used to my new notes here. Alright, so recording the first interest payment. So it's 6 months later. What are we going to record? We're paying out the cash, so we're going to have the cash interest payment. We've already calculated this. We calculated it up here, so it's the $4,000 that we're going to pay every 6 months. We're going to amortize the premium, and that's what we're talking about here. Again, we're going to take the total amount and divide it by 10, the total number of interest payments. So 8,530 divided by 10 is 853. But a premium has a normal credit balance. So in order to amortize it, we're going to do the opposite. We're going to debit the account. So it's often useful to think we're doing the opposite. If we set it up as a credit, we got to debit it to amortize it. And you can look at the opposite for the discount. If we set up the discount with a debit, we credit the account to amortize it. So we do the opposite to write it off. The offset here will be to interest expense again. But this time, you notice, to balance it out, we have to subtract the two numbers. And that's what the premium does. It effectively reduces our interest expense. So amortizing a bond discount decreases the interest expense. And this same entry would be made every 6 months for 5 years. Alright, again, we're going to see what happens at the end of the life of the bond. At the end of the life, we're going to pay out cash. The face value of $100,000, and we're going to take that bonds payable off of our books at face value. Again, it's already assumed that the last interest payment has been made. Alright, the third scenario, we're going to see journalizing bonds, this time at face value. No, this one's the easiest of the three scenarios. So we have $100,000 5-year, 8% coupon rate, and an 8% market rate. So that's what makes it be issue at face value. These two are in perfect balance. And the interest is still semi-annually. So it's saying calculate the present value. Well, this is really easy. Since these two are lined up, the present value is going to be the $100,000. This is a unique scenario. Alright, so issuing the bonds at face value. So we're going to just do all three entries. Journalize the issuance of the bonds above. We're going to journalize the first interest payment. And we're going to journalize the amount required, the journal entry required on the maturity date. So when we issue the bonds, we're going to collect cash, and we're going to have bonds payable on our books, and both are going to be for $100,000. There's no premium or discount. That's what the nice thing is about when they're issued at face value. There's no premium or discount to deal with. On the interest payment, we're going to have a cash interest being paid out, which is equal to the, we'll go and write it down here, $100,000 face value times the coupon rate, which is 8% divided by 2 because it's semi-annually. And the cash interest will be the same thing. There's no premium or discount to amortize. In the third year, we're going to pay out cash equal to the face value, and we're going to take the bonds payable off of our books at face value. Alright, so now we get to those callable bonds. So some bonds are considered callable. This attribute allows the issuer to call to buy them back effectively, buy back the bonds at a price stated in the bond indenture. So this would have to exist already in the bond indenture. They can't just randomly, they can buy them on the open market, but this is a different rate. So they might have a different rate in the contract. And as such, the bonds are called callable bonds. So it says assume a business has bonds payable of $150,000 with unamortized premium of $25,000, and the issuer redeems the bonds by paying $170,000. Okay, so they're just saying this happens like the day after we've issued them, so all these numbers are up to date. It's not like we need to record a partial accrued interest or deal with anything messy like that. This actually simplifies it a lot. So on 830, all right, let's think this through. Basically, we're paying out $170,000 in cash. So the first thing I think is credit cash for $170,000. We need to take the bonds payable off of our books. Bonds payable are a liability. They have a normal credit balance. So to take them off, we debit the bonds payable account. And anytime, just like a fixed asset, when we had to take off the fixed asset and its accumulated depreciation, they're related accounts. Bonds payable and any premium or discount are related. So when you take one off, you got to think about the other one. They have an unamortized premium of $25,000. A premium has a normal credit balance. So in order to take it off, we have to debit the premium on bonds payable. All right, the third step here is to make this balance. So this is 175, this is 170, so I need 5,000 on the other side. So since it's on the credit side, we're going to call it a gain. Here we have, if the last number is a debit, it's going to be a loss, but ours isn't. Ours is a credit, so therefore it's a gain. Alright, you can see the steps I approach it. I approach it in this 4-step process to think about it. So feel free to adapt that. Here's a new definition. It's called net carrying value. We usually net things with their related accounts, like a fixed asset with this accumulated depreciation, we get to book value. This one's for liabilities, called net carrying value. It's the bond face value plus any unamortized premium or any minus any unamortized discount. A bond can't have both. It can have one or the other. So it depends what you have. If you have an unamortized premium, you add it. If you have an unamortized discount, unamortized means we haven't written it off yet. It's not been amortized. Alright, if we want to calculate the gain on redemption of bonds, say we didn't want to do this whole formula, we just want to figure out quickly what the gain on redemption of bonds is. We have a formula for it as well. It takes the net carrying value minus the cash received. Let's calculate it real quick. This bond payable, $150,000 plus the $25,000 premium equals $175,000, which is the net carrying value. If we take the $175,000 minus the cash received of $170,000, you get to the positive $5,000, which represents the gain here. Alright, let's keep moving. Another example with bonds redemption. This time it's going to be at a loss. So we've had the same bonds. We'll move through it quicker. Bonds payable $150,000. This time an unamortized discount, and this time well, I think we paid $170 before. So we'll credit the account for cash account for $170. We'll take the bonds off at face value. We'll take this unamortized discount. Remember, it has a debit balance, so we have to credit the account to take it off. Discount has a debit, so we have to credit it to take it off. And then the opposite, let's see, we got 195 here, so we're going to need 45,000 here. Ooh, this is a big loss. I don't know why they called it. So loss on redemption of bonds at 45,000. It's the same 4 steps. Just remember, if the last number is a debit, we're going to call it a loss. If the last number is a credit, we're going to call it a gain. That just knowing this allows you to not remember this formula. You don't need to remember this if you just adapt these 2 rules. Alright, this is going to scare you, right? What the heck is this? Alright, this is the amortization schedule. I didn't go over a chapter yet with you guys, the payroll chapter, so you guys are lucky you got to skip that chapter in part because we had the hurricane, so we had to get some material out. So this plays on with that one. But this is actually pretty simple. all principal payments beyond 1 year are considered long-term liabilities. So if we have a note that has principal payments beyond 1 year, and this is a monthly payment like for their vehicle. So we see 60 different months, is 60 months in 5 years. But every payment is made up of a principal amount, the interest, and the principal amount of the payment. The total payment is this number right here, but it's made up of different interest and principal, and that changes over time. So long-term portion of this is just the amounts that are beyond 12 months. I wouldn't add up all the different numbers. This is easy to do in Excel. If you had an Excel, just highlight them, it'll give you the total. Or the easier way, if you had to, I'm not going to give you something this long where you had to calculate 12 different numbers, but here it's easier to take the total principal, which we know is $41,000, and subtract out the first 12 months. I put it like this because I covered that in chapter 9, but you guys haven't seen it. But basically, any principal payments beyond 1 year are considered long-term liabilities. It's not the total payment because we don't include the interest. The interest part isn't a liability until the time occurs and we've incurred the expense for the interest. It's only the principal. Alright, the other features of bonds. Okay, this is one of the reasons why corporations like bonds. The interest on bonds is subtracted before calculating taxable income. This makes the interest on bonds tax deductible. We're going to see in the next chapter how this plays, but we're going to subtract out interest related to bonds before we calculate taxable income, effectively saving us money on taxes, as opposed to equity, which happen after we calculate taxable income. So they provide no tax benefit. I'm just going to briefly mention this as a convertible bond. Convertible bond allows the bondholder the option to exchange the bond for a set amount of equity as per the contract, effectively, the bond indenture contract. This allows the bondholder the option to become a partial owner in the business and reap the profits in proportion to the ownership. Okay, so you might see this as like in new businesses to give them it's a benefit to the bondholder because they have an additional option. If the business does well, they can convert their debt into equity and get a bigger payoff effectively. Alright, so the too long didn't read page. I wanted to see how popular these are going to be. I think you can get most of the information on there. Alright, so too long didn't read. A bond is a debt security between an issuer and a bondholder. The contracts are set in the bond indenture. A callable one is one that the issuer can buy back at a stated price. Alright, time value of money states that money to be received in the future is less than money received today. As a result, we must discount future cash flows. We have to discount future cash flows. Be able to use the present value of $1 and present value of a $1 annuity tables. So both types, be able to tell the difference between these two types and use them when appropriate. To calculate a bond's price. Remember, a bond has two different types of cash flows, periodic interest and the face value due at the maturity date. And again, a convertible bond is one that the bondholder can exchange for equity. Alright, if the coupon rate is less than the market rate, what the bond is paying is less than the market, then the bonds will sell at a discount. If the coupon rate is higher than the market rate, then the bonds will sell at a premium. If the two are equal, the bond will sell at face value. The discount on bonds payable is a contra liability account. It has the opposite. It's stored with the liabilities on a balance sheet, but it has the opposite of the normal balance, and therefore it has the normal debit balance, unlike the normal credit balance of liabilities. So to amortize it, we do the opposite. We credit it. Notice if it has a debit, to amortize, we credit it. The premium has a normal credit balance. Premium, normal credit balance. So to amortize it, we will do the opposite. We will debit it. If we're issuing bonds, we want to debit cash for the present value of the future cash flows of that bond. We want to credit bonds payable for face value. Bonds always go on the books at face. They come off at face. And then we have to deal with the premium or discount whenever we issue it. We have to balance it out between these two amounts. The cash that we received versus the amount that we owe, the face value of the bonds. The first interest payment, we're going to credit cash for the amount of the payment. It's always equal to the face value of the note times the coupon rate divided by, in our case, 2, because all of the ones we're going to see are semi-annually. We're going to amortize any premium or discount. So we're going to take the total amount of the discount divided by the total periods, or if it's a premium, the total premium divided by the total periods. And the third step is to calculate interest expense. The interest expense will be the cash interest payment plus amortization of the bond, or minus the amortization of the premium. So you can have one or the other. The amortization of the bond increases the interest expense, where amortization of the premium decreases the interest expense. So this one's looking at interest expense. Maturity date, what we need to do is debit bonds payable for face value and then credit cash for the face value. That one's a pretty simple one, just 2 entries. Redemption of bond. I would first credit cash the amount we paid to redeem the bonds. Remember, redemption, we bought them back. I would debit bonds payable for face value. It says percent of face value if it's a partial buyback. So if we only bought back 50% of them, we'd basically multiply it by 50%. We didn't see an example like that. Remove any discount or premium by using the opposite of its normal balance. Okay, so a premium has a normal credit, so we debit it to take it off. A discount has a normal debit, so we credit it to take it off. And again, if it was a percent one, we can multiply it, say, by 50% or whatever percent buyback it is. The last step is to calculate the debit or credit needed to balance the entry. If the last amount we need is on the debit side, we call it a loss on redemption. If it's on the credit side, we call it a gain on redemption. And for the long-term notes payable, it only includes principal payments beyond 1 year. Alright, that's it for this chapter. I hope you had fun. I'll see you guys next time for the next chapter.